Welcome to the EPK Capital Market Briefing for September 29, 2025. Today, we'll narrate the significant events influencing the global financial landscape over the last 24 hours. As we close this session, we reflect on a month filled with dramatic shifts, centered around central bank decisions, rising geopolitical tensions, and substantial stimulus measures, creating waves of volatility and opportunity in global markets. Let's begin with the key numbers highlighting today's trading session. The US markets showcased impressive strength, with major indices reaching new heights. The S&P 500 ended the day at 5,762.48 points, climbing 0.42% and setting yet another record high. This remarkable session brings the S&P 500's year-to-date gains to 20.81%, showcasing the resilience of US equities amid various challenges faced throughout 2025. The Dow Jones Industrial Average also thrived, gaining 17.15 points or 0.04% to close at 42,330.15, marking a new record. This milestone reflects the continued success of the Dow, which saw 7 record closes in September, raising its year-to-date total to 33 record highs. With a 1.85% monthly gain, the Dow's September performance stands out, showing a year-to-date return of 12.31%. Meanwhile, the Nasdaq Composite gained approximately 0.95% for the week, rebounding strongly after earlier declines in September, signaling the tech sector's volatility recovery. A significant narrative emerged from Asia, particularly Japan. The Nikkei 225 suffered a staggering 4.8% drop on Monday, following Shigeru Ishiba's unexpected election as the new leader of Japan's ruling Liberal Democratic Party. Analysts dubbed this sharp decline the Ishiba shock, reflecting investor unease over possible shifts in Japan's monetary policies. Ishiba's critical stance on ultra-low interest rates stirred concerns, setting the stage for expectations of swift interest rate hikes from the Bank of Japan. In stark contrast, Chinese markets enjoyed their best week since 2008, buoyed by a substantial economic stimulus package from Beijing announced on September 24. The Shanghai Composite surged 2.88% on Friday, closing at 3,087.53 points, achieving an impressive 12.81% gain for the week. The Shenzhen Component Index rose even more dramatically, with a 6.71% jump on Friday, reaching 9,514.86 points, reflecting a staggering 17.83% weekly gain. China's Chi Next Index also experienced history, recording its largest single-day gain ever with a remarkable 10% rise. This remarkable rally stems from the most significant stimulus package since the pandemic, aimed at revitalizing consumer spending and stabilizing the troubled property sector. Turning to central bank actions, the Federal Reserve made headlines with a historic 50 basis point rate cut announced on September 18, marking its first reduction in over 4 years. This unexpected cut lowered the federal funds rate to a target range of 4.75% to 5.00%, showcasing the Fed's dedication to labor market support despite easing inflation. Chair Jerome Powell expressed confidence that inflation is sustainably moving toward the 2% target, representing a strategic pivot that prioritizes employment over inflation concerns. Accompanying projections indicate an expectation of an additional 50 basis points cut in 2024, followed by 100 basis points in 2025. This dovish perspective strengthens risk assets, pushing the equity rally forward. On the other hand, China's comprehensive stimulus package announced on September 24 took center stage as well, integrating a notable 0.5 percentage point cut in the reserve requirement ratio, injecting roughly 1 trillion yuan, $141.82 billion, into the financial framework. The stimulus package includes significant support targeting China's struggling property sector, aiming to alleviate economic pressures through various measured initiatives. The central bank is also striving to stabilize consumer confidence in this challenging environment. Geopolitical tensions spiked as Israel's assassination of Hezbollah Secretary General Hassan Nasrallah escalated conflict in the Middle East. This intense strike on Beirut's southern suburbs utilized US-made 2,000-pound bombs, marking a dramatic increase in hostilities. The consequences were severe, resulting in substantial casualties, including senior Hezbollah commanders. The international community now calls for urgent de-escalation, with President Biden warning against the potential for widespread war in the region. At the United Nations, world leaders confronted escalating conflicts, with President Biden addressing necessary multilateral cooperation amid rising tensions. The UK Prime Minister echoed similar sentiments, underscoring Britain's commitment to global leadership and urging immediate ceasefires in conflict zones. This focus on diplomacy contrasts sharply with the ongoing military confrontations disturbing various regions. In the cryptocurrency sphere, Bitcoin showcased remarkable resilience, outperforming expectations during a traditionally weak September, rising over 10% throughout the month. Trading above $65,000, the leading cryptocurrency defied historical seasonal patterns. Ethereum similarly thrived amid increased network activity, hitting a high of $45 million in weekly fees, reflecting solid adoption in decentralized finance. The cryptocurrency market's strength benefited from easing financial conditions and greater institutional interest, bringing smaller coins into the spotlight as they surged over 20%. As we analyze various sectors, the technology sector rebounded impressively from earlier setbacks, benefiting from both the Federal Reserve's easing and China's stimulus initiatives aimed at enhancing demand for tech infrastructure. European luxury and automotive stocks, notably those with a strong footprint in China, experienced significant gains due to the focus on revitalizing consumer spending. Industrial metals and commodities shared in this surge as expectations for increased Chinese spending grew stronger. Financial observers now address unloved commodities as crucial beneficiaries of China's policy shifts. In the banking sector, stocks rallied amid expectations of improved net interest margins as central banks initiated easing cycles. Insurance companies and financial firms, particularly those with international exposure, thrived from the combination of US monetary easing and China's stimulus efforts. As we analyze economic data, US indicators demonstrated resilience, revealing a robust 3% GDP growth rate for Q2, along with rising consumer sentiment. Core personal consumption expenditures inflation continues moderation, hinting at a decline toward target levels. Weekly jobless claims remained below forecasts, illustrating a fundamentally healthy labor market backdrop. This resilience corroborates the Fed's soft landing narrative, easing recession fears. Meanwhile, Chinese manufacturing and services PMI data reflect ongoing challenges that triggered the latest stimulus response, addressing slow industrial activity and consumer confidence issues. The US dollar exhibited mixed performance, facing pressure from Federal Reserve easing yet buoyed by its status as a reserve currency. Major currencies from trading partners gained ground against the dollar as central banks coordinated easing policies. Treasury yields fell significantly after the Fed's decision, signaling a broad acceptance of risk assets. Gold reached new heights, riding both geopolitical tensions and monetary easing trends, solidifying its role as a safe haven. Meanwhile, crude oil faced downward pressure as concerns about Chinese demand and global growth overshadowed geopolitical risks. Looking ahead, the S&P 500's recent milestone achievement suggests ongoing institutional interest, while volatility indicators point to cautious optimism. Key employment data coming soon will influence market trajectories and Fed policies as we forecast October's economic activity. Geopolitical risk remains a foremost concern, with the Middle East conflict being the most immediate threat to market stability. Investors must remain vigilant as markets adapt to these prolonged tensions. The journey ahead showcases the need for balance between monetary support, economic growth, and inflation control. As we approach the close of September 29, 2024, we find ourselves reflecting on a pivotal month in financial market history. The intertwining of Federal Reserve policy adjustments, stimulating efforts from China, and escalating geopolitical tensions requires careful navigation. Investors should prioritize defensive strategies while seeking opportunities within undervalued sectors impacted by structural changes. The current climate rewards active management and geographic diversification, prompting continuous assessment and adjustments. Thank you for joining our market narrative today. Stay informed, diversified, and remember that patient investing is key. We'll reconvene tomorrow for further explorations of the global economy's unfolding story.